You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
All right, everybody, that music means it's time once again for Options Playbook Radio, the program here on the old network where we break down the world of options into some fun offensive and defensive plays that you can utilize in your own portfolio. If you're saying to yourself, hey, that's that guy, he was on last week, he's on again, what's he doing there? Well, first off, you're right. Secondly, you guys get a double bonus, a double taste of huddles coming out here into the new year, because Brian and I are actually going to be busy around the time of the show next week, talking on some panels about options here in Chicago. So we thought, what better way to reward our patient and quality listening audience here than giving you some nice huddles to chew on here and answering a bunch of your questions, because they do, quite and frankly, pile up here on the show. And of course, who am I talking about? I'm talking about your regular host here, Mr. Brian Overby, the senior options analyst over there at Ally Invest. Brian, welcome back to your own program, and I hope you're getting ready for your big trip up to the frozen north here in Chicago.
Yeah, I should get extended pay for having to go to Chicago this time of year. But with that said, I'm getting excited because a bunch of very smart people are going to get together in a room and they're going to talk about options, and I just think that's wonderful. Not to mention Chicago is my old stomping ground, so it's always great to go back, even though it's a little bit more frigid this time of year in Chicago than it is in Charlotte, North Carolina. So with all that said, though, it's always great to answer some listener questions, and as usual, Mark, I think it's time to huddle up.
The Huddle. It's time to huddle up and answer questions about your favorite options plays. Submit your questions via questions@theoptionsinsider.com, twitter.com/options, facebook.com/theoptionsinsider, or via the Trader Network at tradeking.com.
All right, everybody, welcome to the Huddle, the portion of the show where you guys take the reins with your various questions. Brian, I hope you put your question answering pants on for this one, because we got some epic ones here. Let's kick things off with Joro. He or she wants to know. First off, they say, hi, Brian. So clearly fans of the show. They say, I started trading options this year. Well, congratulations. He goes on to write, and I had some tremendous profits with long, deep in the money calls with expatriation. So probably our friend Joro may be writing from across the pond. With expatriation, more than 9 months, or leaps and some tremendous, he goes on, and some tremendous losses as well, with a high amount of covered calls in a low-quality company, AQXP, that experienced an 80% plus drop in price and thus led to a corresponding loss for me. Well, I'm sorry to hear about that. Joro. He or she goes on to write, the way I select the out-of-the-money calls is using a designed-by-me spreadsheet with different criteria for time, profitability, and risk. And usually this leads to a selection of 25 to 40% deep in the money leaps. Now I want to make something similar, but with a long-term deep out of the money calls. Can you give me advice about what are the best criteria I need to look at in order to find the best suited long-term out of the money calls and time frames. Note the assumption is for a bull market and calls only from a high-quality companies with a stellar balance sheet. Well, you take a lot off the top right there, Mr. or Mrs. Joros. That makes our universe of selection criteria a little bit easier. Let me just correct you on one quick term. I know obviously English is probably not your first language. You did a great job here in your question, though. Just for terminology's sake, it's usually deep in the money and then far out of the money. That's how you differentiate between. So no such thing as a deep out of the money call, but that's just a semantic point I wanted to clarify for you guys out there. This is kind of similar. We had a conversation and a question, I believe, last time, Brian, about calls as well. And clearly people have calls on the brain these days. Not surprising given the fact that we're in a little bit of a sell-off in the bull market, and now maybe last couple of days at least a bit of a retracement. So, Brian, people clearly have calls on the brain right now, and our friend here, Joro, is looking for some tips on what he should include in his spreadsheets for criteria when he's looking at evaluating covered calls.
All right. So, first of all, his last sentence or her last sentence is, no, this is assumption for a bull market and high-quality companies. So, AQXP, I'm not quite sure if that's considered a high-quality company.
I think he's learning from past mistakes there is what he's doing.
Yeah, so if you're looking at it, this is it. The reason why I bring that up, though, in general, is I guarantee there was some premium in AQXP when they were selling covered calls. And that's one of the biggest mistakes I see beginning option traders make, is that they look for the premium and not necessarily look for the quality of the stock. And they just want to sell volatility because, oh my gosh, look at how much premium I can bring in relative to the stock price. It's a great percentage, yada, yada, yada. But what goes with that premium is risk. And Euro saw that and having an 80% drop in that underlying stock. But I guess you would say, I bet you he got paid for that, for receiving that call option. Probably brought in a ton of premium. So that's your first point, would be you want to find, now this is really hard to come up with, and it's a little bit of an oxymoron, but I like to say some volatility with some probability, in that if I have, I want some volatility because I want to get a little bit of premium for my option contract, but I want to kind of understand what's going to happen with that underlying stock. So I don't just chase vol. Just because it's got high vol, you got high vol. But it's nice to have a little bit of predictability in that underlying stock. So when it comes to selling option contracts, I'm just going to say like simple things like the S&P 500 index. It's a little bit, people kind of like it. Why? Because it's an index and you got the SPYs that trade against it, the ETF. You can buy the SPYs, sell the call. That's simple. You got a little bit of volatility. You don't have a ton of volatility, and you got a little bit of premium because it's a high price stock. So just in general, that's a good criteria to come by. Now, when you're starting to look at stocks, you expect to get a little bit more premium because stocks in general are more volatile than indexes. So you do want to look for some high quality companies, a little bit higher price stocks in some instances. You know, they can't be too high where you can't afford to buy the 100 shares. But you like something that's not in your example, it looks like the stock went down to about 2.5 before it was all said and done. You want something that's a medium price stock that has a little bit of predictability in it, and don't just go chasing the vol. And then always, always, always be aware of when earnings are at. That's definitely when you're looking at, especially doing the fig leaf where I'm buying deep into money leaps and I'm selling calls against that position. The next thing that I would mention is leaps. In general, you need to find some liquid stocks also. We just did a study here at Trade King, and when you get down just looking at the top 20 stocks that trade, when you get all the way down to the 20th stock, that's less than 1% of the actual volume that we do every day. So once you get outside the top 20, it's hard to find long-term options that have decent markets. So the actual volume of the underlying stock is something that I would add to my spreadsheet, Because if the stock doesn't have volume, well, then the option contracts are definitely not going to have volume, because you can wipe out an entire call premium received just because you had to pay a bid-ask spread very large on a long-term leap to buy it and to sell it. So those, I guess, some words of advice. I think there's something in there that we can take away from it. But yeah, with leap options, you got to be careful. So there's some times where if the leap market is just so wide that you should just consider buying the stock and ignore the leap. That can happen. If you got an underlying you really like that doesn't have a ton of volume in it, then that's sometimes a better solution.
Yeah, and I would just point out to our friend here, Joro. I'm assuming he's reasonably sophisticated because he knows all these criteria already. But if he's going to tie up all this capital, Brian, in these far long-term, out-of-the-money covered calls, maybe he should think about put spreads instead, right? It's less capital intensive. Obviously, synthetically, he's doing the same thing. So just be aware if you are trading the covered calls. I'm assuming you know this, Joro, but a lot of listeners may not. Obviously, you're synthetically trading short puts at the end of the day. So that might be a much more capital-friendly thing, particularly if you're doing put spreads and you're not tying up a bunch of margin, especially if you're doing longer-term stuff here. Just remember, when you're harvesting premium either way, whether it's, covered calls or short puts, longer-term stuff, the decay doesn't kick in for a little while. So just make sure you understand how that theta is going to kick in, how that theta curve works when you're doing it. But these are great questions here, Brian. We got time for a few more. That was a pretty meaty one, though. Let's go to Alan. He's got a similar question on the other side of the coin here, Brian. Alan Tullman wants to know, there was a lot of research last year regarding selling put options to harvest risk premium. I would add that there's research on that pretty much every year. You just pick your conference, pick your study, and everyone's talking about harvesting the old risk premium. But I digress. Alan goes on to write, now that volatility is back, is this an ideal time to harvest premium via put selling, or does the increased volatility increase the probability of getting whipsaw? This is a frequent question around this time of year, Brian. Maybe I should say this time more in the market, where we're seeing volatility make a resurgence. Obviously, as our friend Joro discovered, it could attract you to some things that could be a little bit dangerous. Maybe whipsaw you out. Maybe they end up biting you at the end of the day. So it's a fine tightrope to walk where you're out there harvesting premium. The more volatility, obviously, the more premium you could harvest. But also, as he points out, the greater chance of having this come back to bite you. So, Brian, when you're out there doing your old harvesting the risk premium in high volatility environments like now, how do you walk that tightrope between collecting enough to make it worth your while, but also not getting bit in the old behind at the same time?
Well, it does kind of go back to what we talked about just a little bit on the last question, in that you want some volatility and some predictability. So if you do have the increased volatility, I would prefer to have more volatility than not enough when it comes to selling option contracts. But ideally, I want to be somewhere in the middle. That would be the best case scenario. The bottom line is you get what you're trading, in that if I got a high volatile market, I can go further away from the underlying stock. So I do have more volatility. I got a wider possibility of stock price movements, but I can move farther away and still get paid for it. So I personally would rather trade in a higher volatile environment, because I can do something. It gives me a chance to adjust my position if it goes against me. Once again, if I have time premium, I can do something with it. Whenever an option contract loses its time premium because expiration is approaching, because volatility comes in, because the underlying stock price moves, once that happens, there's really not much you can do besides take your comeuppance and get out, or ideally take your profits if it's on the upside. So I don't think that there is a specific time on the high side when you should not be doing trades. You just have to, if I'm going to be trading in this environment, I'm going to be watching it a lot closer than if I'm trading in a lower vol environment. As a matter of fact, I think I would go on the opposite end, and I'd turn this question around, and I find it to be a little bit more interesting question. Is there a time when volatilities are so low that you don't want to trade? And I would definitely say that is the case. And I've talked about that a lot in the actual recent strategy sessions of the options playbook, where we talked about doing a lot of time bomb butterflies. I love doing butterflies when vols are high. Why? Because they're cheap to start with, and eventually time premium has to go away. So it makes it more enticing to do strategies like that, because bottom line is, if there's a lot of volatility premium in a 1 week option contract, at the end of the week, that volatility premium's got to go away because there's no more time left. So there you have it. In general, I say yes, keep trading. You just adjust your strategy accordingly.
Well said, sir. I think that's all the time we're going to have on this episode. But we have to, before we go, Brian, we have to choose a victor, a winner here for the old titular options playbook, sir. Which one are you going to go with? You have an unenviable task, sir. I do not envy you having to choose. All of our listeners are winners to me. But Joro, who had the out of the money calls, or are we going to go with Alan Tullman and his put harvesting?
Well, I think I'm going to go with Tullman today, and mainly because I think it's just so timely. When we're talking about volatility premiums and premiums this high, I think that this question always needs to come up. So I always appreciate the timely questions based off of the market. So congratulations, Alan.
There you go. And Brian, if other listeners want to get in on the hot playbook action and maybe send in a question and get their question answered, and maybe win some fabulous prizes, where should they go? What should they do, sir?
Well, you can always email me directly at theoptionsguy@invest.ally.com. That's the options with an S guy at invest.ally.com. And always great to get together, Mark. I always appreciate when you give me some of your time to answer some of these listener questions. And until the next time, may all the options that you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.